name is Jason Laurie, Chief Investment Officer here at Altair Advisors. I too want to welcome everyone to the event, both in person and online. It's great to see everybody back, and I'm excited to be back in front of the podium and not staring at the screen, so hopefully it'll be a little more fun. When we sit down and create the agenda for this annual fall forum, we always start with what are the topics, what are the themes that we want to cover, and then we populate the agenda and invite speakers. And this time it was pretty easy about the topics that we needed to cover, and that was inflation, interest rates, and the Federal Reserve. So you will hear those topics run through everybody's presentation. And you will hear it from different angles. I'm going to start with a market, asset allocation, portfolio management angle. Cara South is going to do it from the trenches of the municipal bond market. And then Professor Eichenberg is going to do it from an economist perspective. So you're going to see different perspectives, but the same themes are going to run through the program. That's how we designed it. And maybe to put a finer point on why did we pick those themes, many of you know that we receive inflation data every month, and in the last 7 data points, we'll start with the statistic and then dive into the slides. Every day that the CPI has been released, the S&P 500, the stock market, has moved on average 3%. 3%, up or down. So it just gives, it's an understatement to say that what's moving markets right now is inflation, interest rates, and the Federal Reserve. That is clearly what's moving markets. So I'll dive right in, both here online and then virtually. You do have, as Anna may have mentioned, all the slides printed out in your folder. For many of you that follow our materials, you know that every quarter we come up with a cartoon. Oops, sorry. Come up with a cartoon, and it encapsulates what we think is the main points of the quarter. We try to be funny, and sometimes we are successful, and sometimes we're not, but hopefully we at least try to encapsulate what's going on. I can take no credit whatsoever for any of the cartoons. David Lynn and his team are the ones responsible for these great cartoons. So we start, I'm going to overview all 3 quarters, bring us up to date. We start with the first quarter, and this is really when the Fed started the interest rate increases. By the way, today is the 8th month anniversary of the first rate increase. Believe it or not, we've only been doing this for 8 months. It feels like 8 years. But we've only been raising rates for 8 months. And that first interest rate increase was only 0.25% or 25 basis points. So this is the Fed, Chair Jerome Powell. You'll notice he'll be the star of all 3 cartoons I'm about to show you. He's just starting this high wire act. How is he going to bring down inflation, but yet not kill the economy, not kill growth? It's going to be a tough high wire act, and Russia's invasion of Ukraine is not helping matters because that added to some of the supply crunch. We move to the second quarter. You notice the same star, Chair Jerome Powell. Now he's officially in rough waters. The second quarter, the S&P 500 was down over 16%, and he is clearly has his hands full. But it's the same tools. It's the Fed funds rate, and it's reducing the Fed's balance sheet. That brings us to where we are today. This is our most recent one, which we all just finished and released the last few weeks. And we're on this steep climb. Today, as we sit here, the Fed funds rate, which is the shortest rate that the Fed controls, is 3.75. And he's climbing. And of course, the debate today is how high is he going to climb? How high is he going to need to climb? And again, this is a topic you're going to see run through all the presentations. And it's a lot of debate as to how high he's going to need to climb. The market is telling us about 4.75, which is about 1% higher than he is today. Professor Eichenbaum is going to take us through a nice discussion about the probabilities that may have to go higher. But right now, the market thinks it's about 1% higher. Let's do a check-in on the markets. I don't think it's new news to anybody in the room or online. that this has been an ugly year across the board. And I think that's one of the key takeaways is it's across the board. It's every single asset class. You start with S&P 500. All these are as of close of business on Friday, the 11th, so last Friday. S&P is down 15%. And then you go all the way down all the equity asset classes, stock asset classes, and again, you see double digit. The worst performing is the technology heavy growth sector. The best performing is the value sector. We're going to see in a second one of the reasons for that is because it has a high weighting to energy. Energy is one of the best performing sectors. In fact, it's the only decent performing sector. Now, coincidentally, but it's interesting, I'm not sure anybody would have guessed this, large cap, small cap, and international stocks, as of close on Friday, all were down 15%, almost exactly 15%. Now, the two bottom rows, which is the reason why we invited Kara South from Gannett to talk a little bit about the bond market, because as stock investors, we know we have to accept volatility. Unfortunately, that comes along with it. But bond investors usually don't like to see this level of volatility. And so the numbers you see at the bottom, taxable bond market down 14%, municipal bond market down 8%, these aren't just bad numbers, these are historic. Most people working in the bond markets today have never seen returns like this. And Kara and David Lynn are going to add a little perspective to this. As I mentioned, that was an asset class view. Now let's talk about the sectors. Again, the slide speaks for itself. There is really nowhere to hide except energy. It's the only sector that did well. Why did energy do well? Well, we had kind of this perfect storm of we reduced production, then Russia invaded Ukraine, and we had this supply crunch in the higher commodities, the higher energy prices goes right to the profits of some of the energy companies, which is why the energy sector from a profit and return perspective did very well. But pretty much across the board, every other sector is negative. So we see every asset class and virtually every sector is negative. Okay, so let's go to one of the elephants in the room, which is inflation. This is why all these asset classes and sectors are so negative. This is a chart of just the monthly CPI readings, and we have what we call both headline and core. Headline includes everything. Core, we strip out food and energy. And as we all know, that this spot over here is we're running at a 40-year high for inflation. Now, the quote good news, at least so far, is you can see that these lines have kind of headed down. And in fact, in this cycle so far, the peak inflation number was in June. We had a CPI reading of 9.1%. Peak inflation, 9.1%. I'm repeating it because that will be key to a few of the slides that I'm going to present and a few of the slides that Professor Eichenberg is going to present. As I mentioned, the Fed funds, or the Federal Reserve, is in control of the federal funds rates, which is the short-term rate. What I did on the screen is I put what did the market think was going to be the high end of where the Federal Reserve was going to have to stop raising interest rates at the end of every quarter. So at the end of March, the first quarter, end of June, end of September. You kind of notice one thing, don't you? The market kept kind of getting it wrong. The market had to keep going higher with its projections. And so right now, this dark blue line is the most recent, what I'm calling now. And the market is predicting that the federal funds rate will have to go up to 4.75, so about 1% higher than it is today. Now you can kind of see, because we've been getting some better readings on CPI, the gap is at least starting to close. The gap is starting to close, but we had this huge gap up here between June and September, and of course, even between March and June. So the market is predicting about 4.75. How is all this interest rates and inflation impacted the bond market? And in particular, up here, I'm looking at the short-term 6-month Treasury. Well, this was yielding basically zero for 2 years and not much more than zero for the previous, basically the entire 6-year period here. And now you can see that we're up at about 4.5%. So the bond market, the short-term bond market has reacted dramatically, and the yield on the short-term Treasury right now, 6-month Treasury specifically, is 4.5. And again, for the clients in the room, you know this is an area that we like, and this is an area that we're moving client portfolios where it's appropriate, where there's bond exposure, a piece of it into this 6-month Treasury, because we find that yield to be very attractive at the 4.5 level. I said that inflation is running at 40-year highs, but we peaked out on the June number at 9.1%. So what I did here is I took the most recent reading, and that's the one we received last week. And if you remember when we received it last week, the S&P 500 was up 5.5% that day, one day, probably a little on the high side, even if inflation did peak. And what we did is we took the October numbers and the April numbers and the October numbers, and just to show you how some of the largest components, CPI has 19 components, I'm showing you the top 10 by weighting. And the message is that although inflation is coming down, and although we've peaked, we have a whole group of categories that are improving or in the green, and then we still have categories that are continuing to, their increase is actually growing. They're growing more. But overall, we do see inflation moderating. One of the other key themes that's going to run through today is this idea of goods versus services. And I think this is going to be a really important part of the discussion. Professor Eichenbaum has a great discussion. He's going to take us through about, well, how did we get here? And a lot of it is we're coming off some crazy levels created by the pandemic. And so right now we're seeing the goods part of the economy, energy, cars, furnishings and supplies when we were all sitting at home ordering furniture. We're starting to see this come back to earth. We're starting to see these things come back down. That's important for inflation. Food hasn't quite got there yet, even though that's certainly a good. All the other categories are services, where we're seeing inflation continue to accelerate. Another look at some data that's moderating. Why is goods coming down from an inflation perspective? This is the new orders on the manufacturing. This is the one I picked, but there's a few that we could have shown. And the first thing you know, the higher the number is the greater the new orders, the higher the new orders, and then the lower the number is the fewer. What you can see is during the pandemic is these readings were almost in crazy territory, and I mean crazy on a good side. The orders were way higher than normal, and now we're finally seeing them get back. So typically when we show charts and we say an index is contracting, that's a bad thing. But nowadays, when things are coming back to earth, it can actually be somewhat of a good thing because we're moderating inflation. And why do we want to moderate inflation? So the Fed doesn't have to keep raising rates and push us into a bad recession. And so bad is kind of good right now when it comes to some of this moderation. Again, on the housing side, we can see that taking place where I think everyone knows the housing market is certainly slowing. 2 years ago, between today, we're selling about 2 million less homes a month, existing home sales. That's our bar chart here. And one of the reasons is not only is the bond market, not only is the short-term side of the bond market reacted, but the 30-year mortgage has reacted. We're running just shy of 15-year highs on the 30-year mortgage. So it's a moderating economy. There's no question about that. And that moderating economy is also moderating inflation. And that was by the design of the Fed. They wanted this to happen. So part of this is actually happening. Another take is a more broad look at the future of the economy. This is the leading economic index, LEI. Again, chart is pretty simple. It's showing that we have a moderating economy, a slowing economy. And the real question here is, can we slow the economy so that we moderate inflation but don't hit a more severe downturn? Again, it's our view that we don't hit a severe downturn. Slow down, absolutely. That's already in the data. But severe is what we want to avoid. Some of the other economic indicators, though, are still pretty positive. If you take a look at the, just this is a spattering, and in fact, this is the grouping, or one of the groupings that the NBER, which is the group that stamps things recessions, look at. So you got everything from GDP to income. Real retail sales, you notice, is the only negative in this chart. That's primarily because finished goods, manufacturing, new orders, is coming down. Now, we actually just got a number this morning, so this bar is actually not quite this negative anymore on the 6-month change. But what you can see is an economy that still has some strength to it, but it is slowing, it is moderating. Okay, so my next two slides are by far my favorite. So we're gonna move into what I call the, okay, so what? What does this all mean for my portfolio, for markets, etc.? Many of you may have seen a version of this before, but we thought it was important enough to reiterate it. What we did is we broke all the post-World War II recessions into two categories. Now, we could have used different definitions, we could have broken it into more categories, but we just did a simple break between two, and we called it mild, and we called it severe. And I also think, as an aside, that's probably a lot of what's going on right now when we're reading things is we kind of have these definitional nomenclature issues. I feel like it's kind of ordering hot sauce. Is it mild? Is it medium? Is it hot? Is it on fire? So it kind of is, we're using different words to say the same thing. But in our world, it's mild versus severe. The punchline is, if you look at this downturn, the S&P bottomed out so far on October 12th, about 25% down for the year. And if you look at the average of all the mild, and we're defining mild by GDP and corporate earnings decline, we're about there. The damage is pretty much more or less done. Can be a little more, a little less, but it's about there. If you believe, which right now we do, you're going to avoid a severe recession. You don't get to these more dramatic levels in the S&P, corporate earnings, or GDP. So right now, we don't believe it's going to be a severe recession. Could it be a mild recession? Yeah, we're not going to get too overly concerned whether it's stamped a recession in 22 or 23, because a lot of the damage has already been done, at least in our view. Now let's take a look at it from an inflation perspective, perhaps the most germane slide of the current situation, which is, when does the market recover after you've hit a period of inflation? And the punchline here, or the spoiler, if you will, is that the market does not wait for inflation to come down before it starts its recovery. And we're looking at these other high inflation periods. Some of them, you can look at March 80 in particular, took years for inflation to come back down to, quote, normal. And then we took a look at the peak, and we looked at the trough. And what you can see is, if you bought the S&P at the peak, so inflation had not yet come down, but it was actually at the peak, your forward returns are very, very good, 1 year and 2 years. But if you actually wait for inflation to go all the way down, the forward returns are, at least on the 1 year average, or flat basically, and then the 2 years kind of average S&P longer term returns. Again, the punchline is, as we all know, the market is forward looking, and it's going to front run the economy both on the downside and on the upside. So the recovery, if that June number, that 9.1% inflation number, was in fact the peak, we're over here now. We're over here now. in waiting for, it's not going to be linear, there'll be a lot of volatility, but the market will not wait for inflation to go back down to the trough before it starts its recovery. Everyone likes to ask us, well, how does the market do after midterms? We just had a midterm election last week. We don't necessarily have the exact results, but we know directionally the Senate's going to go to the Democrats, and it looks like the Republicans will take the House. And it turns out that actually doesn't really matter much from a stock market perspective. We look at every single midterm election from 1950, and you look at 12 months forward, the S&P has been positive. So more of an interesting fun fact than it is market driven, but at least that's what we see right now. My last slide before I do a recap and hand it over to David and Kara is really a setup for their section. Kind of goes back to my comment of that the bond market this year has been historic. These are the annual returns of the taxable bond market. Now, Kara is an expert in munis, but I wanted to use this because it went back a little further. And so the 1976 is the first year that this index started. And what you notice is we've had pretty steady returns. We had 4 of these blips where markets were down. But what do you notice about 2022? You can add up all the losses, those 4 losses, you can multiply them by 2, and you still don't get what you got this year. So this has been historic on the downside for bonds. Let me go through my recap, and then I'll invite David and Kara to the stage. As I mentioned, virtually all asset classes have performed poorly this year. Energy sector is the only positive. Although inflation peaked in June and is now moderating, it's still running at 40-year levels, 40-year high levels. Federal Reserve will keep raising interest rates until they moderate inflation. Right now, the market is predicting another 1% higher over the next few meetings, getting it up to 4.75. The U.S. economy is a mixed picture. We still have some very strong indexes and indices, but there's no question it's slowing, it's moderating. And then finally, probably the most important, I think the midterm election, 12 months forward is more fun than anything, but I think the more significant data as it relates to right now is this inflation, which is that the market does not wait for inflation to go down before it starts a recovery.